Hello, tradeologists. Welcome to Module 11, and this is explosive strategy number 2. We're going to talk about flipping stocks. This is a pretty neat strategy, I think, that you're going to find extremely useful in your arsenal for making money in the markets. This is a business strategy that allows me to buy stocks cheaper than anybody else by placing my order in now. And you know what? If the market doesn't cooperate and I don't get to buy my stocks at the price I want, they pay me for just kind of waiting around until the stock does get to my price point. So it's a really neat strategy for a couple of different reasons. Number one is that we get paid regardless of whether the stock hits our price or not that we want to buy it at. Number two, if it does hit our price, then we get into a trade similar to what we did in part 1 of our explosive strategy number 1, which was to purchase stock and then include a protective put, which is basically a covered stock strategy. The covered stock strategy allows you to protect the value of your stock that you purchased by buying a put on the stock so that if it does go down, it doesn't cover 100% of your loss, and there's always risk in the market, so you're not going to get a free trade. Nobody gets free trades in the market. But what it does do is help you offset the cost of the declining stock, a loss of your investment, by having that insurance on your stock and then allowing you, without any additional money into that trade, take the insurance money, the put that you've sold if the stock does decline, and then use that additional funds to buy more stock so that you can leverage your purchase and get additional stock into your portfolio so that when it does make that rise, it does rally again, that you're going to have, sometimes you can have as much as, double the number of stock that you purchased in the beginning in your portfolio, and eventually the stock does rise and you make money. So that is a longer term trade. Now these trades here, this is a kind of a trade that is pretty simple to implement, but don't let the simplicity fool you, because it is a pretty explosive strategy. You can make good money with it, whether the stock hits your price point or not. Let's take a look at an example, and I'll show you exactly what I mean. Citigroup is a banking stock that has really hit some tough times. Let's take a look at a current graph here. This is a 2-year graph. You can see that the stock topped out pretty much right around 53 going back to June of last year, and it's really gotten killed. It's really just dropped dramatically, especially this period between October and November. Boy, it had a huge drop here. Almost 50% of its value was lost. Well, another 50%, another huge amount of value was lost again from November of last year till now, and it looks like another 20-30%. So we've had a huge drop from its highs, and right now it's sitting right around 1930. It was as high as 53 going back to June of 07. Well, at this price, you may find that Citi is particularly attractive. Now, I'm not saying that this is a good strategy to use on Citibank. Remember, just like the explosive strategy number 1 in this module, you only want to buy stocks that you are absolutely sure are going to be, winners for you in the long term. You only want to be able to put the strategy on for stocks that you want to own. If you don't want to own the stock, do not do this strategy. This is a strategy only if you want to own the stock. So if you think Citigroup has gotten hit too hard here, if you feel investors have been overenthusiastic about selling the stock, and you feel that the Citigroup stock presents to you a long-term competitive advantage in your portfolio, then this is a stock that you might be interested in doing. I'm not recommending Citigroup, though. There's lots of stocks that you could do this on. Let's take a look at Bank of America. Bank of America is another stock that has gotten hit extremely hard in the financial markets, and it's currently trading at $27.10. Unlike Citigroup, though, there is no previous low. Citigroup had a previous low right in here, which is approximately $17.76. So what does that say? Well, you know what? It did rally up from there. It went from 17.76 all the way up to $27. So it did have a slight rally in there, but then it's fallen back down again. Now, here's a strategy that you can use. Let's say you didn't want to jump into the stock right at this point. You could. You could do that. On a stock that's fallen that far, you can see that, you have a number of different options. You can purchase the stock, and you can purchase a covered put for it. Let's just take a look at the 1750 here. Actually, the $20, I would go with the $20 put, and we'll just go ahead and buy it, just like we did in the strategy number 1. We'd go with covered stock, and I'm going to bump that up to 1,000 shares. And if we go ahead and take a look at an analysis of this, you can see that we would have to put up $30,000 in margin. We'd have $940 in total risk on the downside for the stock. And if the stock moved up a couple bucks, we're going to make about $1,000, and from there, it's pretty much of a free ride. So we could, if we wanted to, we could go even deeper. Go down to 2250. That gives us a total risk of only $250 on the trade. However, our break even now is a little bit higher. It's up around 22. Let's take a look at that again. If we use the $20 put on 1,000 shares of stock, our total risk is $940, and our break even's right around just under 21. If we go with the more conservative 2250 put, well, our risk is only $250 at the most on the downside. However, our break even is up around close to the 23 level. So we've raised our break even about 2 points. So, you can be very conservative, or you can be extremely, a little bit more aggressive by buying the lower strike put. Our margin requirement still is $30,000 though for this trade for 1,000 shares. What if instead we did this? Let's say we thought that the prospect of Citibank getting to 1750 is pretty good, but maybe not that great. Let's say it goes back down below this 18 level, right where this little island here, this little island bar is here, and this is where you figure it would be at a very attractive opportunity to purchase just below the bottom of that bar, which is the bottom of this bar is the low is 1776. So at 1750, you feel that it would be a very attractive opportunity. Now, like I said, I am not recommending Citigroup stock. In fact, it's gotten beaten up pretty bad, and it could even fall lower than this. But you felt it was an attractive opportunity to own Citibank, the Citigroup stock, at 1750. In order to do that, you could simply purchase or simply sell the 1750 put. If you bought the 1750 put, you can always exercise that put at any time in the future, because buying a put does allow you to sell that stock at any time in the future. You could buy the call at 1750, and you can buy that stock at 1750 at any time in the future up till the expiration of the July options. So if you wanted to, you could simply buy that call. Well, if you bought that call, what's your total exposure? Your total exposure, if you wanted to buy 1,000 shares of stock, so you bought 10 contracts of the 1750 call, and that gives you the right but not the obligation to purchase the stock at 1750. Now, what happens if the stock moves down to 1750? Well, at 1750, if you did want to buy the stock at 1750, and the stock did move down to 1750, you'd exercise your option. The problem is that you'd have a loss. You'd have a loss of $2,400, because at expiration, if the price of the stock drops to 1750, how much is that option worth that you purchased? It's worth absolutely nothing. It's worth zero. So you'd have a total loss of $2,500. Well, I don't think that's a particularly attractive strategy.